Most parents think gifting is simple. Write a check, help with a down payment, done. But a client recently came to me after giving her son $35,000 this year. She lives in California, and because California is a community property state, she assumed the gift would automatically split between her and her husband for tax purposes. It's a really common assumption, but it doesn't always work that way. Here's what happened. The account she used wasn't actually community property, it was separate property, which meant her gift limit was $19,000, not $38,000 she thought they had together. In this video, I'm going to walk you through 5 gift tax situations that catch even careful planners off guard, including when you are actually required to file Form 709, the IRS gift tax return most families have never heard of, and show you how to navigate them before December 31st. My client's situation is extremely common. Years ago, long before she got married, she opened an investment account while living in Illinois, a common law state. She kept it separate, never added her husband to it, never commingled funds. Then they got married and later moved to California together. Fast forward to 2025. Her son needed help, so she transferred $35,000 from that same separate account. Her husband supported the gift, but here's where things went sideways. She asked, since we live in California, doesn't this gift automatically split between us, like $17,500 each? Here's the truth. Community property rules do not automatically convert separate property into joint property. If the asset was acquired before marriage, kept separate, never commingled, it remains her property alone. So for gift tax purposes, the entire $35,000 counted as her gift. Her annual exclusion is $19,000. She exceeded it by $16,000, so she must file Form 709. Now, there is no gift tax owed. That $16,000 just uses a portion of her lifetime estate exemption, which is nearly $15 million. But it must be reported on Form 709 by April 15th of 2026. And most families don't catch this because they assume community property makes everything joint. It doesn't. Now, let's talk about a different issue. Not what property you are gifting, but how you and your spouse coordinate gifts as a team. Let's say you and your spouse want to give your daughter $38,000, $19,000 from each of you. If the gift comes from a community property account, the IRS automatically treats it as half from each spouse. Each of you gave $19,000, so you are both within the annual exclusion. No Form 709 needed. But if the asset is not community property, the rules work differently. And this is where couples get tripped up. If you want the IRS to treat the gift as half from each of you, both spouses must consent to that on Form 709. And once you make that election, it applies to every eligible gift either spouse makes that year. You can't pick and choose. Here's another example. You elect to split a $38,000 gift to your daughter. Later that year, your spouse gives $25,000 to your son from his own account. Because you already elected gift splitting, that second gift is now split too, and both gifts must be tracked and reported for each spouse. This is where it gets messy fast. Most couples never file Form 709 because they assume the gift splitting happens automatically. Then years later, when one spouse passes away, the estate attorney has to reconstruct years of gifts because there is no clear record of who gave what. So before you and your spouse start making large gifts, coordinate the plan. Decide who's giving what, from which accounts, and whether you need to file Form 709 to document the splits. Alright, so I keep mentioning Form 709. But here's the question most people ask me. If I have to file Form 709, does that mean I'm paying gift tax? Not necessarily. Let me explain the difference between the annual exclusion and your lifetime exemption. Here's what commonly happens. Someone hears $19,000 gift tax exclusion and thinks that's the limit. If you go over it, you pay gift tax. Not true. The $19,000 is the annual exclusion. That's the amount you can give to any person every year without filing any paperwork. But above that, you don't pay gift tax. You use your lifetime exemption, which is $13.99 million for 2025 and increasing to $15 million in 2026. So let's say you give your daughter $50,000 this year. The first $19,000 is covered by the annual exclusion. The remaining $31,000 comes out of your lifetime exemption. You file Form 709 to report it. No tax owed. You just used $31,000 of your lifetime exemption. The problem is, most families don't realize 3 things. 1. Using your lifetime exemption must be tracked on Form 709. If you don't file it, the IRS has no record of it. 2. Your lifetime exemption for gifts is the same pool as your estate tax exemption. If you use $2 million in lifetime gifts, your estate only has $11.99 million left at death. 3. If you don't file Form 709 properly, the IRS can assume you use more of your exemption than you actually did. Here's what that looks like in real life. A couple gives $50,000 a year to their 3 kids for 6 years. Never files Form 709. They don't think they need to because they are not paying gift tax. Then one spouse passes away. The estate attorney asks for records of all lifetime gifts. There are none. The IRS assumes the couple used far more of their exemption than they actually had. It takes months and thousands in legal fees to reconstruct the gifting history. The estate ends up losing about $180,000 in available estate exemption because they can't fully document everything. That's $72,000 in unnecessary estate taxes. But here's what makes it even worse. The estate settlement gets delayed for 8 months. The executor is scrambling to find records. The kids are calling every week asking what's taking so long. And the IRS holds everything up while they reconstruct the gift history. All of this can be avoided by filing one simple form every year. And this is exactly why the right professionals matter. Your CPA handles the gift tax return filing. That's Form 709. Your estate attorney makes sure your trust and will reflect these gifts in your overall estate plan. Your financial advisor coordinates the timing, which assets to gift, when to give them for tax optimization, how the gifts fit into your retirement income plan, and overall wealth transfer strategy. You need all three working together. The lifetime exemption is massive, but you've got to document it. Now, let's talk about timing, because this is where a lot of families lose out. The gift tax annual exclusion is per calendar year. It doesn't carry over. If you don't use your $19,000 exclusion by December 31st, you lose it. Period. You can't backdate gifts. For families with 3 children, if both you and your spouse are gifting to each child, that's $114,000 in tax-free transfers available this year. If you don't use it, it's gone. Over 20 years of retirement, that's $2.28 million in wealth transfers you could have made tax-free, but didn't because you kept saying you'd get to it eventually. That's generational wealth you're leaving on the table. Here's what happens every year. Families realize in late December they forgot to make their annual gifts. They call their advisor asking if they can backdate it. The answer is always no. The gift has to actually be made by December 31st. The check has to be cashed or the stock has to be transferred. If you miss the deadline, that year's exclusion is gone forever. This is exactly why I'm bringing this up now, in November, not late December. If you're planning to make gifts this year, you need time to coordinate with your spouse, figure out which accounts to use, work with your CPA on Form 709 if needed, and get everything executed properly. Start the process now, not December 28th. Now, even if you get the timing and forms right, there is one final coordination issue that ties everything together, and it's the one that causes the most problems down the road. If you have a trust, here's what I see constantly. Families make annual gifts but never update their trust documents to reflect those gifts. Here's the problem. You set up a revocable living trust 10 years ago and funded it with $2 million. Over the next 10 years, you make $500,000 in gifts to your kids, but your trust document still shows the original $2 million in assets. It was never updated. Now you pass away. The trustee opens the trust and sees it should have $2 million in assets, but after 10 years of gifts, there's less than that. The trustee has to reconstruct years of gifts to figure out what's actually in the trust. This delays distribution, costs thousands in legal fees, and creates confusion among your beneficiaries. Plus, if you're making gifts to trusts for your beneficiaries, not directly to them, the rules change. Gifts to trusts can trigger different reporting requirements. And if the trust is irrevocable, you might be using more of your lifetime exemption than you realize. If you have a trust and you've been making gifts, review trust funding right now. Make sure what you think is in the trust actually is. Make sure your beneficiary designations align with your trust provisions. And make sure your estate attorney knows what gifts you've made so they can update your estate plan if needed. Alright. Let me wrap this up with what you actually need to do. If you have $2 million or more and you are helping kids or grandkids, gifting is not a casual act. You need a checklist. First, if you've made any gifts over $19,000 this year, Form 709 must be filed by April 15th. Talk to your CPA now, not in March. Second, if you have accounts you opened before marriage, figure out which are separate property and which are community or joint property before you make any more gifts. Third, if you're planning to give before December 31st, start coordinating now with your spouse and your CPA. Don't wait until late December. And fourth, if you have a trust, make sure your gifts coordinate with your trust funding. Don't create a mess for your family to clean up later. Get these 4 things right and you will avoid the mistakes that cost most families tens of thousands. If you're making significant gifts this year, the stakes are higher than most people realize. A small mistake in how you classify property, which forms get filed, or how your trust gets updated can create problems that cost your family 6 figures to untangle. If If you want to make sure you are handling this correctly, I've put a link below to schedule a brief call. We'll talk through what you are planning. I'll ask some questions about your situation, and we can figure out together whether coordinating everything makes sense or if you're already on the right track. One more thing before you go. If you've been making gifts and you have a revocable living trust, there is another issue we need to talk about. Most trusts are completely unfunded, which means they're worthless. I'll show you how to fix that in this video. Make sure to check it out.